If you are a US citizen living or planning to move to New Zealand, there are a number of important tax and investment issues that you need to understand to manage your financial affairs efficiently. In this video, we're going to dive into New Zealand's rules for being transitional tax resident and the benefits this can offer US citizens. Hi, I'm Jim Smith, Senior Financial Planner here at Pacific Wealth. We specialise in helping new migrants and returning Kiwis navigate the intricacies of cross-border financial planning to help you make the most of your new life in New Zealand. In this video, we're going to dive into New Zealand's rules for being transitional tax resident and the benefits this can offer US citizens. Before we unpack the New Zealand transitional tax residency rules, we first need to understand what it means to be New Zealand tax resident. If you move to New Zealand, your tax obligations depend upon whether you are a New Zealand tax resident. To determine if you are a New Zealand tax resident, there are two different tests that are used. The first is a day count test, and the second is whether you have a permanent place of abode. Under the day count test, if you spend more than 183 days in New Zealand in any rolling 12-month period, you are considered New Zealand tax resident. When counting the days, any part days count as full days, and the total of 183 could be met over several visits. But in most cases, once you've worked out your dates in New Zealand, it is normally fairly easy to calculate whether you've had 183 days or more in any 12-month period to trigger tax residency. But determining whether you have a permanent place of abode is a bit more subjective. A permanent place of abode normally means a house where you normally live, but you don't have to own the house or even live there all the time. It can also depend upon your ties to New Zealand, such as your economic, family or social connections. So whilst tax residency can sound simple on the surface, depending upon your situation, it can become complicated quite quickly, and it's normally a good idea to get this checked by a New Zealand tax advisor. When you become New Zealand tax resident, this will then trigger certain obligations. This includes filing New Zealand tax returns, declaring your worldwide income, and potentially paying provisional tax. If you have received more than 200 New Zealand dollars in income that New Zealand's Inland Revenue Department will not be aware of, you will need to complete an individual tax return referred to as an IR3. This will report all your sources of income, including deductions and tax credits. As a tax resident, you're liable to New Zealand tax on your worldwide income, so this would include income from foreign countries such as the US. In some circumstances, you may have to pay provisional tax if your tax liability exceeds a certain threshold. You should also be aware that New Zealand's tax year runs from the 1st of April through to the 31st of March the following year, which is different from the US, where the tax year runs from the 1st of January to the 31st of December. The New Zealand transitional tax residency rules can exempt those individuals who qualify from paying tax in New Zealand on foreign source passive income for the first 4 years of becoming tax resident. Now, if you move to New Zealand, you can't always be sure that your stay here will be permanent, and there can be a lot of life decisions to work out, such as where you want to live and work and how you will feel being away from family and friends. New Zealand's transitional tax residency rules therefore provide a valuable exemption to work things out before restructuring your financial affairs to fit in with New Zealand's tax system. To be considered a transitional tax resident, there are some qualifying criteria. This includes: you must not have been a New Zealand tax resident at any time in the past 10 years, so you may need to look back at your previous visits and see if any of these triggered tax residency. You must also not have claimed the New Zealand transitional tax residency exemption before, as you can claim this only once. But if you meet the criteria, then you automatically qualify. It is not something that you need to apply for. But you should note that you can lose your transitional tax residency status in some circumstances, such as if you claim working for families tax credit in New Zealand. Whilst you are a transitional tax resident, you will be temporarily exempt from New Zealand tax on certain sources of passive income. This includes rental income from an overseas property, foreign dividends on your foreign shares and interest on your foreign bank accounts. You include investments that would normally fall under New Zealand's Foreign Investment Fund or FIF rules, withdrawals from foreign superannuation schemes, income from foreign trusts, as well as foreign business income that is not related to the performance of services. And generally it's only foreign source passive income that is exempt during the transitional resident period. If you have earned income from wages or employment in New Zealand or overseas, then this is not considered passive and could be subject to tax in New Zealand. The length of the transitional residency period differs slightly based on how you became tax resident. If you became tax resident from the day count test, the exemption is backdated to your arrival date and will last for 48 months from being tax resident in New Zealand. If you became tax resident from establishing a permanent place of abode, the 4-year ends the month after you established the permanent place of abode, so this might mean your tax residency period is slightly shorter compared to the day count test. The transitional tax residency rules provide individuals with a period of time to determine if you want to stay in New Zealand longer term, as well as presenting certain financial planning opportunities to keep foreign investments outside of New Zealand's tax environment. Having an understanding of these rules can help you develop a plan for holding and managing your assets to maximise this period. You should also develop a plan for adapting the strategy to fit in with New Zealand's tax environment before the transitional tax residency period comes to an end. Hopefully this video has given you an understanding of New Zealand's transitional tax residency rules and the benefits this can offer US citizens. As always with tax, what may start simple on the surface can get complicated very quickly. As such, I would strongly encourage you to seek professional tax advice at your earliest convenience and ideally before you move to New Zealand. If you are interested to learn more, we've created other videos specifically for US citizens that you can explore on our YouTube channel. You can also visit our website www.pacificwealth.co.nz, and if you have any questions, please feel free to reach out to myself or a member of the team. Thank you for watching.